EPK Capital presents Daily Brief for 1st September 2025. Hello everyone, welcome to EPK Capital's Daily Brief video. I am your host, Rutvik. In this series, we try and update you and make sense of all the important news from the world of finance that came out globally. So without further ado, let's begin. Introduction, a red day on Wall Street and beyond. If you're looking at your portfolio this morning, you're likely seeing a sea of red. After hitting fresh all-time highs just yesterday, Wall Street took a decisive step back on Friday, capping off a volatile week and an eventful month. This wasn't just random profit-taking, it was a market reacting to a potent cocktail of catalysts. We have a crucial inflation report that's complicating the Federal Reserve's next move. A sharp and painful sell-off in the tech sector that's raising questions about the AI rally, and the geopolitical temperature is rising with new tariffs and renewed tensions over Taiwan. It was a day where the macroeconomic reality bit back. In today's deep dive, we're going to break it all down. We'll start with the closing numbers from around the globe to get the lay of the land. Then, we'll dissect the main event, the July PCE inflation report, and what it means for a September rate cut. We'll perform an autopsy on the tech sector sell-off, looking at the big names that dragged the Nasdaq down. We'll then shift to the global stage, covering the new U.S. tariffs on India and a high-stakes U.S. delegation visit to Taiwan. We'll also have a special report on the blockbuster announcements from the Reliance AGM in India. And finally, we'll wrap up with the crypto markets, where caution is the word of the day. The global scorecard, closing numbers from around the world. To understand the day's narrative, we first need to look at the numbers. The negative sentiment was widespread, with nearly every major global index finishing the day in negative territory. The declines were particularly pronounced in the United States, where the technology sector bore the brunt of the selling pressure. A closer look at these figures reveals a clear divergence in the US markets. The tech-heavy Nasdaq's steep 1.15% decline stands in stark contrast to the Dow Jones Industrial Average's more modest 0.20% dip. The S&P 500, a broader mix of the economy, landed in the middle with a 0.64% loss. This disparity tells us that the day's pain was not evenly distributed, but was intensely concentrated in the high-growth, high-valuation technology sector that has led the market for much of the year. This wasn't a broad, indiscriminate sell-off. It was a targeted retreat from the market's biggest winners. The timing of this downturn adds another layer of significance. The sell-off came just one day after both the S&P 500 and the Dow closed at record all-time highs. Such a sharp and immediate reversal from a peak suggests that conviction among bulls is fragile. It implies that the negative catalysts of the day were potent enough to instantly overwhelm the prior day's bullish momentum, signaling that traders are quick to take profits at the first sign of trouble. This pattern often points to a period of consolidation or further downside as the market digests new information and reevaluates risk at these elevated levels. The main event, deconstructing the PCE inflation report. The primary catalyst for Friday's market jitters was the release of the July Personal Consumption Expenditures, PCE, price index from the Bureau of Economic Analysis. This is the Federal Reserve's preferred measure of inflation, and the market was watching it with bated breath for clues about the central bank's next move on interest rates. The headline numbers came in exactly as economists had forecast. Headline PCE rose 2.6% over the last 12 months, the same rate as in June. Core PCE, which strips out volatile food and energy prices, rose 2.9% year over year, a slight acceleration from the 2.8% seen in June. On a monthly basis, headline PCE increased by 0.2%, while core PCE rose by 0.3%. On the surface, an inline report might seem like a non-event. However, the market's negative reaction reveals a deeper anxiety. The critical issue is the direction of travel for the core inflation metric. At 2.9%, core PCE is now moving further away from the Fed's 2% target, not closer to it. This reading matches its 16-month high on a rounded basis, challenging the prevailing narrative that inflation is on a smooth and steady decline. This isn't a sign of inflation being defeated. It's a sign of its persistence, complicating the path forward for monetary policy. This data crystallizes the difficult dilemma the Federal Reserve now faces. Just last week at the Jackson Hole Symposium, Fed Chair Jerome Powell struck a notably dovish tone, acknowledging that downside risks to employment are rising and signaling a willingness to cut interest rates to support a softening labor market. Yet today's sticky inflation data makes that a much riskier proposition. Cutting rates could add fuel to the inflationary fire, while holding rates steady could exacerbate the weakness in the job market. As Powell himself described it, the Fed is in a challenging situation where it is being pulled in two directions. Despite this complication, the market is still betting heavily on a rate cut in September. According to the CME FedWatch tool, traders are pricing in an 87% probability of a 25 basis point cut at the next FOMC meeting. The logic is that the Fed has signaled its priority is the labor market, and it will look past what it may deem temporary inflation pressures, some of which are tied to newly imposed tariffs. However, the path beyond September is now much less certain. Economists suggest that while the Fed may deliver one cut, it will be difficult for them to move as quickly or aggressively as they'd like with subsequent cuts if inflation remains stubbornly high. This puts an immense amount of pressure on the next major data release, the August jobs report. That report will now likely be the decisive factor in either confirming the market's dovish expectations or forcing a painful repricing of the Fed's future path. While the PCE report set the macroeconomic stage, the day's real drama played out in the technology sector. The Nasdaq's 1.2% drop was fueled by significant declines in the semiconductor industry, with the closely watched PHLX Semiconductor Index, SOX, plunging nearly 3%. This wasn't a broad-based panic, but a reaction to specific concerning news from some of the industry's biggest players, casting the first real shadow of doubt over the AI-driven rally that has powered markets all year. The key movers tell the story. NVIDIA, the undisputed leader of the AI boom, fell over 3%. While its quarterly revenue was incredibly strong, growing 56% year over year to $54 billion, the company's commentary on its China market expectations was described as dour, disappointing investors who have become accustomed to nothing less than perfection. Dell Technologies, Dell. Shares plummeted 8.9%, making it the worst performer in the S&P 500. The company actually beat second quarter estimates, citing strong demand for its AI servers. However, its profit forecast for the third quarter fell short of Wall Street's consensus estimates. And in this market, that was enough to trigger a massive sell-off. Marvell Technology, MRVL. The stock plunged a staggering 17% to 18%. The chip designer's data center revenue for the second quarter, a key metric for AI infrastructure, missed analyst forecasts, and its overall sales outlook was weaker than expected. The market's reaction to these earnings reports signals a crucial shift in investor sentiment. For months, the narrative of an unstoppable AI revolution has been enough to propel these stocks higher. Now, investors are beginning to reassess the runway for AI-related spending. NVIDIA's caution on China, a massive market, and Marvell's miss in the data center segment are concrete data points suggesting that the path of explosive growth may face significant headwinds. Furthermore, the severe punishment meted out to Dell and Marvel demonstrates that this has become a show-me market, not a tell-me market. A slight miss on guidance or a single weak metric is no longer being overlooked. The market's tolerance for anything less than a perfect report has evaporated, a classic sign that the unbridled optimism of the past few months is giving way to a more cautious and skeptical stance. Adding to the negative sentiment, industrial bellwether Caterpillar, CAT, saw its stock drop 4.5% after it explicitly raised its annual cost estimates due to tariffs. This provided a tangible link between the geopolitical tensions brewing in the background and the real-world impact on corporate bottom lines, creating a negative feedback loop for the market. Not all news was bad, however. Autodesk, ADSK, shares jumped over 9% after delivering strong earnings and raising its full-year forecast, proving that excellent company-specific performance can still be rewarded even on a broadly negative day. The geopolitical cauldron, tariffs and Taiwan. Broadening our view to the global stage, two major geopolitical developments on Friday added significant layers of risk and uncertainty to the investment landscape. First, trade tensions between the United States and India escalated dramatically. Effective August 27, 2025, the U.S. administration imposed an additional 25% tariff on all Indian imports. This is on top of existing duties, bringing the total tariff rate to a staggering 50% for many goods. The official justification for this move marks a significant shift in the use of trade policy. The White House explicitly stated the action was in response to India's continued purchase of Russian oil, directly linking the economic penalty to a foreign policy and national security issue. This is no longer a simple trade dispute about protecting domestic industries. It is the use of tariffs as geopolitical weaponry to enforce foreign policy objectives, setting a more volatile and unpredictable precedent for global trade. The impact on India is expected to be severe, particularly for its labor-intensive and export-oriented sectors. Industries like textiles, gems and jewelry, seafood, and auto components are bracing for a major hit, with small and medium-sized enterprises, MSMEs, likely to be disproportionately affected. For instance, Indian-made ready-made garments now face a total tariff of 61%, making them highly uncompetitive against rivals from countries like Bangladesh and Vietnam, who face tariffs around 31%. In response, the Indian government is reportedly preparing a multi-pronged strategy to cushion the blow, including promoting Made in India products and considering domestic tax cuts to stimulate internal consumption. Second, tensions in the Taiwan Strait ratcheted up as a high-level U.S. congressional delegation visited Taipei. The delegation was led by Senator Roger Wicker, the influential chairman of the Senate Armed Services Committee. During the visit, Senator Wicker used unusually direct and forceful language, repeatedly calling Taiwan a free country, with the right to remain free and preserve self-determination. He went further, warning of a China-led axis of aggression that threatens global freedom. This rhetoric represents a significant departure from the long-standing U.S. policy of strategic ambiguity regarding Taiwan's status. By using language that appears to recognize Taiwanese sovereignty, the statements directly challenge Beijing's core territorial claims. China's reaction was swift and furious. Beijing condemned the visit as a serious violation of the One China principle that undermines China's sovereignty and territorial integrity. This hardening of the U.S. stance and Beijing's sharp rebuke increase the risk of miscalculation and escalate an already tense situation. For global markets, this raises the long-term risk premium for any company reliant on the region's critical supply chains, most notably the semiconductor industry. The potential economic disruption from a conflict over Taiwan is estimated to be immense, potentially running into trillions of dollars. India in the spotlight, Reliance's vision for the future. Amidst the global market turmoil, one of the most significant corporate events of the day took place in India. The 48th Annual General Meeting, AGM, of Reliance Industries Limited, RIL. Chairman Mukesh Ambani laid out a series of blockbuster announcements that outline a bold vision for the company's future and have major implications for India's technological and economic landscape. Key announcements included Jio Platforms IPO. Ambani confirmed that Reliance is preparing to take its massive telecom and digital services arm, Jio Platforms, public by the first half of 2026. This is widely expected to be the largest IPO in India's history and is aimed at unlocking value on a global scale. Reliance Intelligence. A new wholly owned subsidiary was unveiled, tasked with a fourfold mission to house India's next-generation AI infrastructure, build AI services for the Indian market, foster global partnerships, and nurture AI talent. Global AI partnerships. To accelerate its AI ambitions, Reliance announced 2 landmark partnerships with U.S. tech giants. A deep collaboration with Google will establish a Jamnagar cloud region dedicated to Reliance, combining Google Cloud's AI technology with Reliance's own green energy and network infrastructure. Additionally, a joint venture with Meta will focus on developing enterprise-grade AI solutions for Indian businesses, leveraging Meta's open-source Llama models. New energy and chemicals investment. Anant Ambani detailed a massive R75,000 crore, $8.8 billion investment in new oil-to-chemical projects and a dramatic expansion of its new energy initiatives, including a target of building over 500 compressed biogas (CBG) plants by 2030. New product launches. The company also unveiled a suite of new consumer-facing products, including the Jio PC, a cloud-based personal computer, Jio Frames, AI-powered smart wearables, and Ria, a voice-enabled search assistant for the Jio Hotstar streaming platform. These announcements represent more than just a corporate strategy. They signal a private sector-led effort to build a sovereign technological capability for India. By creating Reliance Intelligence and partnering with the world's leading AI firms, Reliance is positioning itself to drive India's adoption of AI across every sector of the economy. This is a unique model of national development, where a single corporate giant is building the foundational infrastructure for a country's digital future. The planned IPO of Jio Platforms by 2026 provides a clear catalyst for investors. The move is designed to publicly benchmark the value of Reliance's digital ecosystem against its global peers, which will likely attract a massive wave of international investment into the Indian market and force a re-evaluation of the entire sector. The stock's negative reaction on the day of the AGM is likely a short-term sell-the-news event, possibly combined with investor concerns about the enormous capital expenditure these ambitious plans will require. Crypto market update, caution, and capital rotation. The risk-off sentiment that swept through equity markets on Friday also spilled over into the world of digital assets, where caution and indecision were the prevailing themes. Bitcoin, BTC, fell through key support levels, trading down about 1.35% to around 111,115. Ethereum, ETH, also saw declines, trading near $4,487. The broader market sentiment has clearly shifted from bullish to neutral, with the Crypto Fear and Greed Index sitting at 47 out of 100, reflecting widespread investor uncertainty. However, a look beneath the surface reveals trends that are unique to the crypto space. The derivatives market, a key indicator of professional trader sentiment, was flashing a major warning sign. The options expiry on August 29th was one of the heaviest of 2025, with traders having positioned over $5 billion into bearish put options. This massive volume of bets against a price increase shows that sophisticated investors were actively paying to protect their portfolios against a significant downturn, a much stronger signal of bearish conviction than simple price action alone. At the same time, a clear pattern of capital rotation is emerging. While the overall market is down, the flow of funds shows a distinct preference for Ethereum over Bitcoin. In the past week, spot Ether ETFs have attracted a staggering $1.83 billion in net inflows, while Bitcoin ETFs have seen more modest inflows of $171 million. Some data even points to outflows for Bitcoin funds contrasted with inflows for Ethereum funds during the same period. This divergence suggests that investors are not abandoning the crypto space entirely, but are reallocating capital. This shift is likely driven by Ethereum's compelling narrative, which includes institutional interest in staking yields, its foundational role in the decentralized finance (DeFi) ecosystem, and the ongoing excitement surrounding its own ETF products. This indicates a maturing market where investors are making more nuanced, asset-specific decisions rather than treating all cryptocurrencies as a single, monolithic asset class. Ultimately, however, the crypto market's performance on Friday reinforces its status as a high-beta macro asset. The timing of the digital asset sell-off aligned perfectly with the negative reaction to the PCE report and the tech stock tumble. This shows that when macroeconomic uncertainty rises, investors tend to reduce risk by selling their most volatile assets first, a category that currently includes both high-growth tech stocks and cryptocurrencies. Conclusion and look ahead, what to watch next week. So, to wrap up a turbulent Friday, the key takeaway is uncertainty. We have uncertainty from sticky inflation that is complicating the Fed's job. We have uncertainty in the tech sector, as the AI darlings are finally showing some cracks. And we have rising geopolitical uncertainty, with trade wars heating up and tensions simmering in the Taiwan Strait. The market is telling us that the easy gains are over, and it's now grappling with some very real headwinds. What does this all mean for next week? All eyes will now be on the August jobs report. This has become the single most important piece of data on the calendar. A weak report will likely solidify a September rate cut and could bring buyers back into the market. A strong report, however, would put the Fed in an incredibly difficult position and could trigger another wave of selling. The market is on a knife's edge, and the labor market data will be the catalyst that decides which way it falls. That's your global market wrap for Friday, August 29th. It's a complex picture out there, and we'll be here to help you navigate it. If you found this analysis valuable, be sure to hit that like button, subscribe to the channel, and ring the bell so you don't miss our next update. Have a great weekend, and we'll see you next week. And that's all we had for this video. Just a quick reminder that this video is for educational purpose only and should not be taken as financial advice. For your personal financial advice, kindly get in touch with us on details in description, or you can connect with your financial advisor. Thanks for watching. If you found this video valuable, please hit the like button, subscribe to our channel, and let us know in the comments which company you'd like us to analyze next.